Rates are about to drop, and you're either Netflix or lock ready. We're watching home prices rise like it's a sad sitcom. If you wait too long, you'll be outbid by the guy who showed up with a pre-approval and a hoodie that says, "I told you so."
Yeah, Manley, people keep saying, should I wait till rates fall? That's like saying I'm just gonna wait till my gas tank's on empty while you got a backseat full of kids needing some Cheerios. Just doesn't make sense.
Hey, when it hits, it's going to hit fast. Multiple offers, seller leverage, and a regret that hits harder than your fantasy football loss.
That's why we're mapping this out now. Netflix and lock isn't just a cute tagline. It's a survival strategy. Prep now, win later. Otherwise, you'll be binging on Zillow while someone else moves into your dream home.
Trying to time this market is like trying to catch toast midair, and it's burnt, and it's late, and someone else already buttered it.
It's just a matter, is it going to be surprised when the bill comes, or did you know before you started getting your third slice of cheesecake?
Mortgage spreads are bloated like the Thanksgiving plate, man. They're over 300 basis points.
Is the seller going to get the short end of the stick? Is the buyer going to get the short end of the stick? Hopefully you like all the education that you're getting from Manley and I. Do us a favor and smash that like button, subscribe and follow, and tell all your friends and family about us.
Welcome to the Mortgage 101 podcast with Anthony and Manley.
Aloha, Manley. Good to see your beautiful, big, red flannel.
Hey, love to see you out there in Hawaii with your palm leaves on your beautiful shirt, looking good. You got your lava lamp rolling in the background.
That is a Himalayan salt lamp. You take that back right now.
I apologize, sir. Your Himalayan kitty cat in the back. And your great Mortgage 101 podcast sign in the back that matches mine here. Happy to have all you guys here.
Manley, let's talk about the elephant in the room. When you and I are compiling all this data for this podcast, our job is to find out and go through the muck of what is going on so we can give some more runway to our viewers, to our listeners, and to our clients. And the big thing that keeps popping up is the feds are dropping hints, man. What does that mean? We know the 10-year Treasury is flashing warning signs at 4.40. It's signaling long-term rates are preparing to slide. That's your cue. Not the Fed's press release 3 months later. We are seeing tangible evidence that we are seeing rates drop. And that's what we need to see.
Yeah, Anthony, you're absolutely right. Mortgage spreads are bloated like the Thanksgiving plate, man. They're over 300 basis points. Hey, when we normalize, you could still see a rate drop even if the Fed stands still. The boys out there, they're making more money than they should, but they're preparing themselves because they're being in a very defensive mode. They're backing themselves up because they don't know what's going to happen. And the Fed is not reacting like they think they should react. So they're just holding pat. They're being very defensive. So that's why our spread is wider than it should, giving us that old Thanksgiving plate full of you know what.
Yeah, Manley, you're spot on. I mean, the feds are pretending to be cool, but the data shows otherwise. Inflation is softening. The labor market is settling in. And yeah, it's election year. They're going to blink. And they're blinking right now, 100%. Waiting for the feds is like waiting for the green light in Mario Kart. By the time you react, 3 other buyers are already zooming past you. And that's exactly what's going on right now. And that's why we're really sounding the alarm to our buyers going, if you're looking to purchase within the next 5 years, the next 90 days are most likely going to be the most economical.
Yep. Watch yourself. Watch your six. That's all you have to say. Watch your six.
Yeah. So next up on the bat is the bank of mom and dad. This is something that you and I see on a daily basis with all of our applications coming in. I mean, family help is the new norm. It's not the exception. In fact, 1 out of 4 younger buyers are getting help from their down payment from their mom and dad. It's not cheating, it's adapting.
Hey, Anthony, we were just preparing for this. And you were talking to a buyer about splitting up, or not a buyer, a donor, about splitting up the gift in certain proportions because he needed to give $31,000, but they wanted to spread it out, so that they were giving 2 specific gifts that are half, so they didn't meet any tax consequence behind it. So that was really interesting that we're talking about this now, but we deal with this every day, how the gifts are given and who's giving them. But yeah, hey, Venmo, it's not a mortgage tool. If your family is gifting funds, you need a signed gift letter. You need proof of the transfer of the funds and full documentation, not a memo with a $sign on it. Hey, this is what we're doing.
Yeah, I agree. Co-buying with the family too, we see a whole bunch. Non-occupying co-signers, occupying co-signers. That's not a trust fall. That's a business deal. Title structure, tax implications, exit plans, all of it matters. Do the right thing or risk turning Christmas dinner into a small claims court because you didn't look at the small stuff, right? You got to make sure all of these things are dialed in, especially when you're mixing business with family or business with pleasure. That's facts.
Anthony, winging it equals loan denied. We've seen more deals fall apart from undocumented family gifts that just show up out of nowhere. Talk to your lender. Let them know what you're doing. There's a specific way that this needs to be done, and it can be done as long as it's very transparent. And do it our way, the way that we coach you to do it. Super important. It's a deal killer, folks.
Yeah, man. And speaking of, granularity and really understanding the process, let's talk about non-QM loans, man. They're not weird anymore. They are not the oddball out. Non-QM is not weird. It's just ahead of the curve. You're self-employed, crushing it, but your taxes look like ramen budget. We've got a loan for that. And guess what? It's not B or C or D tier. We're talking A tier. Sometimes the non-QM actually has a better rate than conventional financing, and we can do 40-year terms. When you look at a 30-year amortization compared to a 40-year, you're still paying the same interest in the beginning. You're not worried about year 31 through 40, but now you're dropping your payment as much as a third because you're stretching it out another 10 years. Yeah. That's called diversifying and monetizing products we have nowadays to try to keep that cash flow as good as possible and where rates are super high right now.
Yeah. Hey, you're spot on. This is not the island of misfit toys anymore. These are real. We need to have these products, and they are great that we're coming out and doing some common sense loans are finally hitting the world in the mortgage world. A bank statement loan is one of those where we use deposits to qualify you and not the IRS's opinion of what your business expenses look like. Super important to talk to your advisor, talk to your loan officer, and let him lead you down the path that makes the most sense, because there's a lot of people out there that before just couldn't qualify. But now with these types of products, anything can happen. And if you're a business owner, you're self-employed, here's where the magic happens. Let somebody like Anthony or myself really guide you through this. We'll show you how we can make magic happen and let your actual bank statements work for you instead of your tax return working against you.
Yeah, and one of the big buzzwords we see right now is the DSCR loan, right? A lot of people mess it up and call it the DSRC, the DCRS, the DART. There's so many different things. It's DSCR, Debt Service Coverage Ratio. It's a plug and play for real estate investors and for regular investors. If the rent covers the mortgage, you're in. No W-2s, no taxes, no problem. It's all about the income from the asset and not the income from the individual. This is a game changer if you're that person that likes to show your income like a top ramen budget, but in reality, you're leveraging taxes and tax incentives to not have to pay Uncle Sam so much. When you look at a traditional loan, we have to go off the net after deductions. With a debt service coverage ratio or DSCR, it doesn't matter what you make. It matters what the asset makes. And that's where it's a win.
Hey, I got another really great product for you too to just put on the plate here for you. Got no job, but you got a lot of assets? Asset depletion turns your net worth into a mortgage ammo, my friend. It's a cool product. We can calculate qualifying income based on what you do have and not the fact that you don't have a job. Very cool. Again, got to have the right person working it through. There's a couple ways to structure that accordingly and make it happen for you. It's a great product.
We have some entrepreneurs that they'll take off a year or two. They'll sell a company. They'll do this or that. Or they're retired and they have pension or they have a massive amount of 401k. That doesn't stop them from purchasing. So I agree 100%. And that's why it's important when you talk to your mortgage lender like Manley or myself, you're getting educated. You're getting confident. You're understanding what options are available, what options are not. You, the buyer, you're not the professional. You have no idea what's out there. It's up to us to educate you and show you, especially in these crazy times. And speaking of crazy times, man, market volatility means opportunity. We cannot stress that enough and scream it on the mountaintops. I mean, MBS markets are frozen like bad leftovers right now. They're not crashing. They're just unsure. That means there's time to act before lenders reprice. Remember, we always talk about how the market likes to be on a defensive aspect. It likes to set up on a defense to make sure that they see the runway. And if there's volatility, there's no runway. We're going to see that baked in their pricing. We are now seeing that disappear within our eyes. It's absolutely crazy what we're seeing right now.
Hey, Anthony, we're talking about spread compression. That's the stealth rate drop. That's where we're lowering that gap that we talked about previously. That's where we're going to see the rates go lower, even without a rate Fed cut rate. Can't speak, but that's okay. The Feds do drop the rate. We could see that continue on, but if they don't drop it, we could still see it because we're going to see the compression in the gap.
Yeah, you touched on a big aspect of our business, right, Manley, about the compression. This is not a one-trick pony. This is not like a one-size-fits-all. There's a lot of stuff that we need to do. The one thing is don't prepare after the drop. Prepare before. Get the docs in, credit checked, pre-approval done, know your payment, know your out-of-pocket, know your options. Because when the music starts and the chairs disappear, which they will disappear fast, you're going to wish, man, I wish I listened to Anthony Manley because I would have been proactive in my home search and not picking up the scraps or finding the broken chair with the missing leg because I waited too long. That's what's going on.
Hey, Anthony, newsflash for you. Trying to time this market is like trying to catch toast midair, and it's burnt and it's late and someone else already buttered it. If you guys are liking all the information you're getting from us, if you're feeling that we're educating you, please smash that like button, subscribe, DM us with any thoughts or ideas for our show, and also tell your friends and family about it. Share us on social if you can. Would love it. All right, folks, it's the ever popular rapid fire buzzword section with our producer Ryan. This is the meltdown edition.
All right, guys, buzzwords. One sentence only. If you ramble, I'm shutting off your mic, or at least Manley's, because I can't do Anthony's mic. But I can't mail him glitter, so that's another option as punishment.
You're going to glitter bomb me?
Just might. All right. Today's first word is appraisal gap.
I think that's when your offer is higher than the appraised value, meaning that you offered $300,000 and your appraisal came in at $250,000. So you have a $50,000 gap. You better have some cash to cover that, right, Anthony?
Yeah, or get ready to renegotiate or bounce. If you're buying something and the professionals are saying it's only worth this much, and the purchase price is this much, that's the gap. Is there going to be a meeting of the worlds? Is the seller going to get the short end of the stick? Is the buyer going to get the short end of the stick? It depends. And so that's the appraisal gap.
All right, like you trying to lead me into term number 2, which is escrow.
Yeah, it's where money and paperwork sit. It's the third party, poncho. It's the guy who's not with the seller, he's not with the buyer, he's with the transaction. And that's what you want. You want a third party.
He's the protector. In other parts of the world, the escrow is when you're setting money aside for your taxes and insurance. Two different things. I'm not trying to add confusion.
All right, our third term for today, which is something that a lot of first-time home buyers hear a lot about, is PMI.
Did you say TMI, too much information? Or you said P as in Paul, MI? That's when you put less than 20% down.
Yeah, it's annoying, but it gets you in the house, right? If you want to wait till you're Dave Ramsey and you have $1 bazillion in the bank, yeah, PMI is no good. But if you're the rest of the normal Americans that don't have $1 bazillion in the bank, then PMI is your friend. Would you rather have to save $100,000 to put down on a house? Or would you rather ask mom and dad for $15,000 and then have a $200 mortgage insurance payment? I mean, it's so simple. I mean, just think what you can do with that extra $100,000 rather than sitting in an asset that you already have, regardless if you put $200,000 or $100,000 down. You can make more money on a return, whether it's crypto, whether it's stock, whether it's IRA, whether it's a blend of everything. Shoot, find a double wide for $100,000 in Pimi Valley and have a $900 payment, rent it out for $1,500. Now that's cash flow. And so, in my opinion, PMI is the secret weapon. PMI allows you to leverage debt to create income, whereas no PMI means you had to create income to not have that debt, which means you have income tax.
Our fourth word for today is pre-qual versus pre-approval.
Hey, pre-qual is talk, pre-approval is when we walk.
Yeah, one gets you in, the other gets you laughed out at a showing. I mean, you walk in with a piece of paper and you're not fully vetted, you're only as good as that paper. How many times, Manley, do you and I hear from a listing agent or a buyer's agent going, hey, Lockett Warledge gave us an approval, And then
Yeah.
they waited until the last very day and they said, oh, sorry. And it's because they got 10 million departments and what they give you is not really confirmed. Did they confirm the income, the assets, the transcripts, the employment, the credit? Did they go through everything? Did they certify it? If they didn't, you're walking around with a potential time bomb, and you don't want to do that. You want to be fully vetted, fully approved. It's a big difference.
It's just like anything. There's good loan officers out there and there's bad ones. And there's bad ones that put out that pre-approval that's junk. A pre-qual is absolute junk. It's the back of a cocktail napkin. The best one of all is the power bid that we offer here at Rate, where we fully underwrite you. So there is no ifs, ands, or buts about it. We're getting you fully to the table, already ready to rock and roll. We're just waiting to get an appraisal. We're waiting to get title, and we're waiting to get homeowners insurance. Super easy. Moving on.
All right. Our final term for the day is closing costs.
Ooh. What are closing costs? Well, that's that extra stuff that you forgot to budget for because somebody didn't tell you, by the way, the money that you're bringing for the down payment, you still need a little more than that. There's funds above and beyond the down payment that's required. I personally do a really good job and articulate that in writing, give somebody a really good ballpark figure within a couple $100 of, how much money it's going to take above their 10% down payment. They're bringing $20,000 for that 10% down payment, and it's probably going to be, X amount of dollars beyond. I prep them up front, so it's not a surprise. I get so many people that come to me and say, my lender never talked to me about any of that stuff. He just bamboozled me and said I just needed my 10% down. It's just not how it works.
Yeah, it's, closing costs are like tipping your lender, but it goes to everyone else. It ain't going to us. But did your lender advise you when they were serving a buffet of food to you? Were they telling you, oh, by the way, there's a cost for that, there's a cost for that? Or did they just wait and let you just take all the buffet and then at the end go, here's your bill? You want to make sure that your server is serving up good, hearty information, but also letting you know what it means. And so, closing costs are always going to be a part of the dinner. It's just a matter, is it going to be a surprise when the bill comes? Or did you know before you started getting your third slice of cheesecake?
Awesome. Love it.
Hopefully you like all the education that you're getting from Manley and I. Do us a favor and smash that like button, subscribe and follow, and tell all your friends and family about us.
Hey, guess what time it is, Anthony?
Rate prediction tracker.
Dun, 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 dun. What have these fools been telling us? Hey, we've been talking about this every episode, and we bring this up so that we can sit there and track. We hope that there's like a betting pool in the background somewhere, people saying the over and under, what's really going to happen here. Folks, the current average 30-year fixed rate's at about 6.68%, up slightly from last week's 6.63%, showing continued volatility, but an upward trend. So what do you think about that?
Man, our forecast range is always and will be for this year 5.8 to 6.25. Target QE averages is 6.15. The spread remains over 300 basis points, meaning the Fed's cut could be exaggerated by the market's reaction. But I mean, when we look back starting in January, we can see a trend. We were at 6.85 leading into this year at 2025. February ticked down to 6.79. March, again, another track down to 6.71. April, we're going even lower. We're digging it down, 6.63. May, 6.58. And now we hit a ledge of 6.68. Now we're talking a tenth, right? 0.1% higher from May, from 6.58 to June, 6.68. Mark my words. Let's see what happens in July. I think we're going to have an Easter surprise, and we're going to see smaller than 6.68 for July. We'll see. We'll see what happens. But my prediction is we're going to see an average under 6.68, and we're finally going to start going down, going to that mid mark, and we are so close, and we still have 4 or 5 months left of this year. We got some time.
Rates are hovered, but hey, next 90 days could break the pattern. Be locked and loaded. Be prepared. Talk with your lender. Like we've been saying all along, be prepared.
We're not talking if, Manley. We're here. It's not like in January we were like, well, if they do this. Now it's when. It's when the feds are going to do it. That's the thing.
We are certainly on the cusp. We are certainly on the cusp.
If you are going to buy within the next 5 years, you are literally waiting for longer lines, more cost up front, and a higher purchase price. End of story. You are not going to wake up and go, oh, the purchase price is lower. Oh, the sellers are being too friendly and giving closing costs. Or, oh, I'm the only one adding an offer to this beautiful, highly upgraded, perfect area house. No, you're going to go, oh my gosh, the selling agent said there's 7 offers. Oh, and they want highest and best. Oh, and they want us to waive the appraisal contingency. Wait, so I just saw $20,000 increased on my bottom line? Well, what happened? Well, you waited till you pushed the gas pedal a second too late.
Yep. It's coming. Back to, I think you said earlier that if we see rates at 6% or lower, we're going to get 5.5 million new buyers that are now capable of purchasing in this market. The floodgates will open, and it's just going to make the bidding wars get even harder to resolve. So,
yeah, I mean, Netflix and lock isn't just a clever tagline. It's pretty dope, actually. I think you and I can coin that, Netflix and lock. But it's your move, man. Prep now, win later. Otherwise, you're going to be binging on Zillow while someone else unpacks in your dream house. You're going to be like, oh, that could have been me.
Hey, baby, don't wait for the parade. Be the one mapping the trail. You've got the blueprint. Now go execute. Talk to your mortgage lender, somebody like Anthony or me, and we'll help you get there.
Mahalo, Manley.
Great to see you, brother. If this episode helped you feel more confident about your home buying journey, do us a favor. Share it with a friend, subscribe, leave a review, and if you've got a question or a topic you want us to cover, hit us up with a DM or a comment. Thanks for listening to the Mortgage 101 podcast. We'll see you next time.
Manley.
Yeah, what's up?
Knock, knock.
No. Not knock jokes. We're not doing this anymore.
Manley. Knock, knock.
Oh, my Lord, Anthony. This is getting very old.
Knock, knock.
Who is there, Anthony?
Rate.
Rate who?
Rate now would be a good time to get pre-approved.
I need to move out of this podcast.
No need to worry, Manley. I will be filing a restraining order against knock knock jokes on this production from this point on.
Oh my God.